Hello, my name is Kyle Soley, and with me is Sebastian Watt. We're with the law firm Reed Smith. A lot of exciting things are happening with tax reform. You thought you heard all there was to hear about tax reform, but you thought wrong. Really exciting things happening. First of all, not getting a lot of press, but there's a piece of federal litigation challenging the transition tax under Section 965, the Moore litigation. So problems with the transition tax. And this year, 2021, this is the third anniversary of when you filed your tax returns, reporting the transition tax, reporting the tax on the accumulated earnings under Section 965. So that means that this is a year in which you'd need to file a refund claim, either at the federal level related to that Moore litigation, or at the state level. Sebastian and I are going to talk about opportunities in 21 states today where there are refund opportunities related to Section 965 and the transition tax. A lot of exciting stuff. But before we begin, a couple of housekeeping items. If you have any questions during the webinar, you can submit them through the Q&A window. If we don't get to them in our presentation, we'll follow up with you afterwards. There's materials in the event resources window on your console, and the program is eligible for CLE in all the jurisdictions that we serve. So throughout the webinar, you're going to see polling questions, and those are just to make sure that you're awake. Of course, you will be, but this just confirms that you are, so that the folks who are monitoring the CLE credits can give you the credit that you deserve. So let's jump right into it. Let's jump into this Moore litigation. Is there a problem with the transition tax, problem with the tax under 965? Well, there's litigation going on in the Ninth Circuit, Moore versus the United States. The Moores would say, yes, there is a problem. The Moores have filed their brief, and the Treasury brief is due this coming July. So what is this case about? Well, first of all, the Moores are individuals, but don't let that convince you that the case isn't relevant for your corporate taxpayer. It is relevant. The fact that they're individuals doesn't matter for this purpose. Well, the Moores invested in a company that makes small-scale farm equipment in India, and that company was quite successful. But the company reinvested all of its earnings in research and growth in India, and has not made any distributions to its owners. The Moores are minority owners of the business and have not received any distributions. They made this investment, and these earnings have been accruing since the middle part of the last decade, or actually middle part of the decade before last, just around 2005, 2006. So many years worth of earnings have accumulated. And then, of course, along came tax reform, and the federal government, Congress, said, we want to tax some of that accumulated earnings that you've accumulated over a decade. What the Moores have claimed is that the transition tax on accumulated earnings, is unconstitutional, violates the U.S. Constitution for two reasons. One, the 16th Amendment. For those of you who went to law school, 16th Amendment, of course, was the reaction to Congress's first effort at imposing an income tax. Income tax was struck down because it's a direct tax and wasn't apportioned among the states. It didn't make sure that it correlated with state population, and it was struck down by the courts. The 16th Amendment was passed, and the 16th Amendment essentially authorizes Congress to pass taxes that are direct taxes without apportionment, but only if those taxes are income taxes. So the first thing the Moores are saying is this tax is not an income tax. This tax is a tax actually on our property. And the Moores actually have case law behind them. There's a case from the early 1900s, Eisner versus Maycomer. And in that case, the U.S. Supreme Court said that a tax on income of a corporation that's not distributed is not income in the hands of its shareholder, and therefore is an income for purposes of the 16th Amendment. The other thing that the Moores are arguing is that the tax is impermissibly retroactive. For them, it goes back over a decade. For a lot of folks listening to this webinar, you pay transition tax, the accumulated earnings may have gone back to the 80s, so much more than that. So certainly if the Moores win on that basis, a lot of taxpayers who are listening to this webinar may have a similar problem. So there's a real question about the transition tax being in jeopardy because of what the Moores are doing. So with that, Sebastian, what will happen if the Moores win?
Thanks, Kyle. Well, so I guess the big question really is it a good thing or a bad thing if 965 is found unconstitutional? It might sound like a good thing because we all put a lot of work into figuring out 965, and ultimately a lot of companies pay tax on it, but might not be that straightforward. So on one hand, you pay tax, cash tax on 965. And if you hadn't really repatriated the cash and you don't ever intend to repatriate the cash, well, 965 isn't great because it's the only reason that you're paying tax on these foreign undistributed earnings is that 965 is forcing the derepatriation. And those are the Moores facts. I mean, they intended to permanently reinvest their foreign earnings. And 965 really is the only reason that they're ever going to pay tax on those foreign earnings.
So Sebastian, if that's you, refund claim. You may want to file a refund claim because you're not benefiting from the good stuff, the tax-free repatriation of the cash.
Yeah, absolutely. And then the Moore litigation problem most likely is not going to be over this year. So by the time a court decides whether or not 965 is constitutional or not, it might be too late to file refund claims. So exactly, I think the idea would be protective refund claims. I guess, on the other hand, 965 was a huge benefit if you didn't permanently reinvest your foreign earnings. And that's because 965 really kind of functioned to be a huge tax break at the federal level. If you had brought your earnings back home in 2017 without 965, they would have been taxed at a 35% rate. But instead of 35%, because of 965, you pay tax at 8 or 15.5%. So yeah, it accelerated the tax into 2017. You're losing some time value of money if you don't bring the cash back. But if you do, it cut the rate by over 2/3. And for most taxpayers, that meant at a minimum a big financial statement benefit on deferred taxes. So what if 965 is held to be unconstitutional? So the first most basic question is, do you get a refund at the federal level? Was just mentioned, that's probably going to depend on whether the statute is open. It most likely will not be when the Moore litigation is finally over. And so if you do want a refund on the tax you paid as a result of 965, you're probably going to have to file protective refund claims. But the more important question and the more interesting question is, do you even want a refund? And that really depends on your facts. Because if you get a refund, the next question is, will you have to pay tax in the year the cash was or will be actually distributed? And the answer is, yeah, there's risk that you'll have to pay tax when it's actually distributed. And evaluating that risk is a little bit difficult now before we know what a court is going to do with 965. But the risk sort of depends on what the court is going to do or what the court would do after it finds 965 unconstitutional. The question is, will the court throw out any other TCJA provisions, any other tax reform provisions when it throws out 965? Remember that 965 is intended to be a transition from a regime where foreign dividends brought back to the U.S. Were taxed to a regime where they're 100% deductible. That's why we call it the transition tax. So you might think, yeah, well, I'm going to go file my refund claim, get my 965 tax back, and then you won't have to pay any tax at all on those foreign earnings going forward because you get 100% dividends received deduction for dividends from foreign subsidiaries. So you get the benefit of tax reform's transition to a system that doesn't tax foreign dividends, but you didn't have to pay the transition tax because it was unconstitutional. Sounds great. Well, if you're the U.S. Treasury, you're probably going to argue that Congress intended the transition tax was a condition for getting the 100% dividends received deduction for foreign earnings. And a court might agree with that. So it's possible that if 965 is unconstitutional, you lose the foreign dividends received deduction. That gets thrown out as well. Of course, it's possible that a court strikes all of the TCJA. If 965 is unconstitutional, everything gets thrown out, the lower rate, the 100% bonus, all the good stuff. But at a minimum, it wouldn't be surprising if the court finds that Congress wouldn't have intended the foreign DRD without the transition tax. The one thing that's interesting about the Moore case is that it is individuals that are challenging 965. So this sort of question about the 100% DRD going forward and the relationship between the two is not directly implicated because individuals don't get that 100% DRD for foreign dividends going forward. It's only available to corporations. But that probably doesn't matter. The 100% DRD could come up anyway when the Moore court, if it finds 965 unconstitutional, engages in a severability analysis. When it asks, okay, if we lose 965, what else needs to be removed from the statute? What else would Congress not have enacted if it had known that 965 was unconstitutional? So let's say that the court throws out 965 and the foreign dividends received deduction, and you filed and got a refund on the 965 tax. Well, that might not be a good result. You'll get a refund on the tax you paid on 965 earnings, but now you're getting taxed at 21% on the actual distribution. You might be better off. A lot of taxpayers might fall in this boat. You might be better off if the statute closed in 2017, where you file refund claims and maybe withdraw them, if you don't get a refund for the 965 tax. If you don't get a refund on those earnings, your foreign undistributed income from 1987 to 2017, that income that was subject to 965, should remain previously taxed income and be excluded from gross income when the cash is brought home.
So probably no whipsaw risk. If you're gonna repatriate that and you're gonna benefit from the advantageous tax reform treatment of the repatriation, probably no whipsaw risk in not filing a refund claim.
Yeah, that's exactly right. Just because 965 is thrown out does not mean that the mechanism that prevents the double taxation of foreign earnings is going to be thrown out with it. The code section that says that those earnings that you're taxed on are not double taxed or not taxed again is section 959. That'll stay in the code, and as long as you included the 965 income in the tax base and paid tax on it, if you work through the mechanics, it's very likely the right answer is that 965 will exclude those earnings when distributed. I'll mention there's a slight whipsaw risk. It's a little bit technical. It relates to the portion of 965 previously taxed income that is previously taxed because of E&P deficits. We won't get into that here, but if 965 does get struck, you might want to dig into this sort of potential whipsaw on a small portion of 965. Said another way, if 965 is thrown out, there is a potential for a small whipsaw risk, but not on the entire amount of 965 income. So if you're in a situation like the Moores, that is, you permanently reinvest your foreign earnings, you might want to consider a refund claim. So let's do our first polling question. I'd be interested, would you benefit if the Moores win their case? Your answer is most likely yes. If you are like the Moores and you permanently reinvest your foreign income overseas, and so you receive a refund of the tax you paid on 965 with no additional cost on the actual distribution. B, no. You like the lower tax from repatriated earnings. You like that you pay tax at 15% or 8% rather than the U.S. statutory rate. C, no, you don't really care about 965, but you don't want to risk losing the foreign dividends received deduction going forward, or D, maybe. So I'll leave the polling question up as we move on. Please just answer in the next couple of minutes, if for no reason other than the CLE and CPE credit. So Kyle, what happens at the state level if the Moores are successful?
Yeah, so the question is, and really the state, whether to file a refund claim at the state level or not is different than the decision about whether or not to file a refund claim at the federal level. because some of the dynamics that Sebastian talked about, that is, for example, whether or not the income that you pay tax on is going to be treated as previously taxed income, are not going to be relevant at the state level. Put differently, getting a refund on the tax you may have paid at the state level may be a pure benefit to you at the state level without the unpleasant side effects that you have at the federal level. So you definitely want to consider whether you're going to file a refund claim in case the Moores win at the state level, even if you have no intent of doing that at the federal level. Then the question is would a refund be automatic if you were to file a refund claim at the federal level under Moore? The answer is it depends. In some states, the refund would be automatic, but in other states, not so. So you do want to consider states where you paid significant tax based on 965, potentially filing a protective refund claim. Many of those claims would be due this year to protect your rights in case the Moores win. So it's definitely a state by state, but definitely protective refund claims are something that you want to consider. With that, I'm going to turn it to Sebastian. We're going to take a little bit of a detour. We're speaking of states. And take a look at what was initially going to look like an overwhelming chart of 21 states, but we're going to make it simple for you. We're going to break it down into component bite-sized parts. So with that, I'll turn it to Sebastian.
Thanks, Kyle. So this chart is sort of going to be home base for the next 40 minutes or so. But it's not that we're not going to move around. We're going to move it around. Right. A little bit, but this is good. I don't want the people to get too nervous that they're going to be staring at the same chart for 40 minutes. Right. No, home base, we're going to leave or we're going to come back. We're going to leave and come back. So down the left side, let's just break this down simply, explain what this chart's going to do, and then we'll take everything off of it and we'll build back to this point. So down the left side, we've got the states that tax 965 or have 965 related issues. We're including there's a number of related issues to 965. We're including we're going to talk about the biggest one. There are several states that don't tax 965, but the provision has caused an NOL issues. For example, if 2017 was a loss year for you, 965 probably ate some of your NOLs. And for some taxpayers, that's been an even bigger issue than state tax on 965 itself. One comment I'll make here is that, a lot of these states that tax 965 are smaller. The states that are taking the most aggressive 965 positions, Nebraska, Rhode Island, are smaller. Others like Massachusetts and Nebraska and New Jersey are taxing only a small portion of 965. So it doesn't seem that big, but there are serious constitutional issues here. And one reason we're doing this presentation is to show you that you're not alone and to give you the tools that you need to fight these assessments, that that there are a whole lot of arguments and ways to get your money back. No matter how big or small it is. And we're happy to send you, a sample protest rider that you can use in some of these states to preserve some of the issues we're talking about today. There's a whole toolbox available, and we want you to have it. So we've got the states down the left, and then the problems. So the next big section of the chart is problems. We'll walk through those in a second. And then all you see in red, the vast majority of the chart is solutions. That's where we're going to spend our time. So let's just do another quick polling question, just interested to see where everybody is. Are you facing state 965 issues on audit? Just leave that up for a minute, and if you just answer that question again, if for no other reason but for the CLE and CPE credit. But we'll go ahead and move on. So here's our empty chart. Let's start with filling in the problems. There are about 16 states that tax 965. That is, some portion of 965 is included in the state base, and there's less than 100% DRD. Some of these are as little as 5% inclusion in the tax base after the DRD. It's like Massachusetts and New Jersey. Others are as high as 100%, like Nebraska and Rhode Island. I'll just touch on some nuances that we're not going to spend time on. For example, Oklahoma, dividends are allocated, so you're only paying tax if you're domiciled there. There are states included here that effectively tax 965 through expense disallowances. That is, you get a deduction for the 965 income, but you have to allocate things like interest expense, which could result in an effective tax on that 965. So this is not the entire universe of 965 problems, but this is the vast majority. We're sort of simplifying the universe here a little bit. We have 2 states that don't tax 965, but we find that a lot of taxpayers are having issues as a consequence of 965. You pay this federal tax, you want to bring the cash home. These states don't provide a full dividends receipt deduction for actual foreign dividends, and they don't follow the federal previously taxed income rules. That means that when you bring your cash back and you think it's going to be tax-free, you've got a nice surprise waiting for you in these states, more tax. Finally, there's 4. The other big problem we're going to talk about today are 4 states that don't tax 965 in 2017, but the interplay between the 965 inclusion in federal taxable income and the state deduction for 965 eats your NOLs, which are Delaware, Florida, Missouri, and New York. We're also going to talk about New Jersey in this group. It both taxes 965 and eats your NOLs. We'll explain a little bit more about the nuances of New Jersey a little bit later. So let's going back to where Kyle left off. These are the states highlighted in red here in the slide that tax 965, and if the Moores win, you could be entitled to a full refund on your 965 tax paid on these states. You can sort of ride their bootstraps and ride the Moore's bootstraps and get a refund in these states. Of course, you won't get a refund if the statute's closed generally. That's especially true if you decide not to seek a refund at the federal level. So you should consider now whether it makes sense to file protective state refund claims in these states. All right, so let's talk about our next issue that we're going to use to fill in this chart. Separate company states that tax 965 income: Louisiana, New Jersey, New Mexico, and Tennessee. In short, a lot of you watching this have probably already heard that separate company states arguably can't tax 965 at all. And to us, it's more than just a position. It's really the right answer. And that's because of the Supreme Court's decision in Kraft versus Iowa. The question in that case was whether a state could treat income earned in U.S. commerce more favorably than income earned in foreign commerce. Iowa used federal taxable income as the state tax-based starting point. And at the time, federal taxable income allowed a deduction for dividends from U.S. subsidiaries, but not foreign subsidiaries. So if you got a dividend from a U.S. subsidiary, it wasn't taxed by Iowa. Iowa allowed the federal dividends received deduction. But if you had a dividend from a foreign subsidiary, it was taxed by Iowa. And that's because there was no dividend there was no deduction at the federal level, and there was no deduction at the state level. And the Supreme Court held that differential treatment between income from foreign and domestic subsidiaries violated the Foreign Commerce Clause of the U.S. Constitution. The Foreign Commerce Clause says that the federal government regulates America's commerce with other countries. And the Supreme Court has interpreted that sort of positive grant of power to the federal government to mean that states are prohibited from regulating foreign commerce. And for state taxes, what that means is that states can't treat foreign commerce less favorably than domestic commerce. So a state that says no dividends received deduction from English corporations, for example, because we don't like their funny accents, well, that could cause a sort of a foreign relations issue. And so for that reason, the Foreign Commerce Clause is essentially a per se rule against states doing anything like that. The court doesn't look at the degree of discrimination. It's just a per se rule against treating foreign subsidiary income less favorably than domestic subsidiary income. So the question is whether 965 violates Kraft. And we think it's pretty clear that it does. Let's take a situation where you have a taxpayer that invests in 2 subsidiaries that are the same in every way, except one subsidiary does business solely in the U.S. and the other does business solely outside the U.S. In this situation, 965 creates a mandatory distribution from the foreign, but not the domestic subsidiary. Conforming to 965 means that the state is taxing undistributed foreign earnings, foreign subsidiary income, but not taxing undistributed domestic subsidiary income. And the only reason for that tax on the foreign subsidiary's income is that it's foreign. And for that reason, to us, it pretty clearly treats the foreign subsidiary income less favorably, and so it's discriminatory on its face. And if it's discriminatory on its face, the answer, especially based on more recent Commerce Clause cases involving the Commerce Clause, if there is a discriminatory tax, it's pretty clear that it is unconstitutional. The Supreme Court has been clear more recently that any discrimination is virtually, in the Commerce Clause context, is virtually per se unconstitutional. And that's because the state has to meet a really high bar to argue that a discriminatory tax should not be struck down as unconstitutional. And there's no really reason why that sort of per se rule of invalidity that the Supreme Court has reaffirmed multiple times more recently than the Kraft case in the Commerce Clause context does not apply to the Foreign Commerce Clause context. So in short, Kraft prohibits separate company states from taxing 965. There's a couple nuances in a couple states I want to mention. First, Louisiana. Louisiana had a temporary 72% dividends received deduction in 2017 that went back up to 2018. But for 2017, the DRD was 72%. That DRD applied to foreign dividends, domestic dividends, 965 income, everything. So at first blush, you might think, or Louisiana might argue, that the state doesn't discriminate between foreign and domestic dividends because everyone's treated the same. Everybody gets the 72% DRD, whether it's a distribution from foreign or domestic subsidiary, or whether it's 965 income. But in our view, there's still facial discrimination here. And here's why. If you have a taxpayer that invests in two subsidiaries that are the same in every way, except one does business solely in the US and one does business solely outside the US, and both subsidiaries distribute all of their pre-2018 earnings on January 1st, 2018, there's different tax treatment in Louisiana. The domestic earnings, the earnings by the domestic subsidiary wouldn't be taxed because the cash is included in the state base and then it's subtracted. 100% is subtracted because in 2018, Louisiana has 100% DRD. But the earnings of the foreign subsidiary are not included in the tax base, even though the cash came home in 2018. And that's because they were deemed distributed under 965 in 2017. And because they were deemed distributed in 2017, they were deemed distributed in a year where Louisiana's dividends received deduction was only 72%.
So Sebastian, Louisiana, really, anybody who has a distribution in any year other than 2017, in other words, other than the year in which 965 income was recognized, they have this opportunity.
That's right. That's right. If you paid $1 of tax on 965 in Louisiana, and you didn't bring that cash home in 2017, you waited to bring it home in 2018 or any year thereafter, you paid too much tax on 965 in Louisiana. The second is New Jersey. I just mentioned this partly because New Jersey's now combined, but in the year of the 2017 inclusion as a separate company state. I also mentioned it because it was a state that had previously 100% dividends received deduction, but it reduced it to 95 partly in reaction to tax reform, in reaction to the deemed repatriation. So it might seem like New Jersey's not taxing too much of 965, only 5%. And you layer that on with a favorable 965 apportionment regime that New Jersey also enacted. And you might say, well, that's not too bad, New Jersey, that's too much. But I say that that's pretty sneaky. New Jersey is trying to sort of, seems like, get away with imposing what is, most practitioners agree, is an unconstitutional tax by making it small enough that it's not going to raise the ire of a large group of taxpayers. Instead, they're trying to take little nibbles out of a lot of corporations, get some bigger nibbles out of some bigger corporations, and hope that no one's going to challenge it. But I think the point here is that if you're paying $1 of tax in New Jersey on 965 income, you're paying too much. So let's go back to our chart and then fill in the solution to the tax on 965 income in separate company states. For these states, you can take the position that you exclude 965 income from the tax base under craft. So Kyle only touched on a minority of the states here. They're separate company states. What about combined group states?
Great. Thanks, Sebastian. So combined states, here are the combined states that tax Section 965. There are a number of them, right? And you may think to yourself, well, they're not going to have the same problem, right? They're not going to have the same problem because a domestic corporation, although a separate company state, a domestic subsidiary's income is not taxed. In the combined state, it is, right? They're all combined together, and the domestic subsidiary's income is taxed with the other members of its group, including its parents. So you wouldn't have the same problem, would you? Well, the answer is you could have a problem. The problem is just a little bit different. We're going to go through that. So I think the defense most combined states have is, look, is the income of the subsidiary in my base? And the answer is, in a combined group, all the domestic income is in the base. And in a combined group under Section 965, only some of it is. Only the accumulated earnings since 1987 is in the base. So a combined state's going to say we actually treat our foreign subsidiaries better. You have no craft problem. The problem, though, is once you get to apportionment. In a combined group, you're going to have all of the gross sales of those domestic subsidiaries in the factors. But in most states, you don't have any of the gross sales in the factors in a combined return, even though you have the 965 inclusion. Therefore, you have a craft problem. The craft problem is a little bit different. It's not income inclusion, but it's a different apportionment. But craft doesn't let you treat domestic subsidiaries differently, regardless of how you're treating them differently. It doesn't let you treat them differently. It doesn't let you treat their income worse. So we think that the problem really amounts to a factor representation problem that elevates itself to the level of a craft problem because of the different treatment of foreign subsidiaries compared to domestic subsidiaries. So what's your solution? Well, the first solution is, well, I should be able to at least include the 965 income in the factors. And many states will let you do this. And the question really is that enough? Well, the first question to ask is, well, when the state lets you include 965 income in the factors, what are they letting you include? Are they letting you include the 965A amount, or are they subtracting the 965C deduction and requiring you to only include the net amount? And there's a number of states that only allow you to include this net amount. The example here, we have $100 of 965A income inclusion, the $56 deduction under 965C, and there are a number of states that say you should be content with getting the 44 in the factor. And our answer is no. At least you should be able to get the 100 in your factor. After all, it's a sales factor. Deductions shouldn't count against you. And therefore, in these states, the ones that are colored up here, those states are states that would say you ought to be content with the net amount. And we would say no, you should get the gross $100 amount. That is the entire 965 income at the very minimum in the factor in those states. So when you go back to your office, take a look at those states and see whether you included only the net 965 amount, and whether you'd benefit from the 965A amount. But of course, there's more than that, right? How did you get that 965 income? Well, that 965 income is as a result of accumulated earnings over a course of years. And your earnings are, at a simple level, your gross income, your gross sales, less your deductions equal the E&P. So in our example here, we have a taxpayer that had $1,000 worth of sales over the relevant period. The relevant period here is important. The relevant period is 1987 to 2017. $1,000 of sales, $900 of deductions, produced $100 in E&P that ended up coming in under 965. Our view is that whole $1,000 should go in the factor, sales factor denominators, if the state includes 965 income in the base. But at a very minimum, consider putting the amount, which is 440, in the factor. And what that amount is essentially, you take a look, what's the proportion of the net 965 income that's included in the base? In other words, the $44 net compared to the $100 gross income under 965, right? The ratio there is 44%. Multiply that by your sales over this period, and that should be what you put in the sales factor at a minimum. Again, what we think you should do is take a look and maybe include the whole 1,000. But if you're feeling sporting with the states, include the 440. But many states, they're going to make you fight even to get to 100 in. So going back to our chart, in all of these states, in all these combined states that include 965 income in the base, we think you should be including the CFC sales at the most 1,000, maybe the 440. But one of those two numbers seems to us to be the fair amount to be included in your sales factor, and that can have a significant impact on your calculation. So with that, I'm going to turn it back to Sebastian. I think, Sebastian, we're going to talk a little bit about some other statutory issues.
Thanks. Yeah. So there's a couple states that tax 965 without statutory authority. That is, the state tax administrators have taken it upon themselves to tax 965. And those two states are Nebraska and Rhode Island. So both states have 100% dividends received deduction for foreign dividends. And both states have historically applied that state dividend deduction to Subpart F income. But now they're reversing that position. 965 income is a type of Subpart F income. But now the revenue agencies in these states are saying Subpart F income that is 965 is not eligible for the state subtraction. It's taxable. There's been a lot of talk about this issue in the news in Nebraska. I should say tax news, tax notes in Law 360, because Cost recently sued the Nebraska Department of Revenue, seeking a declaration that their policy of taxing 965 is contrary to Nebraska statute. And the focus of that litigation now is really about whether Cost has standing. But the briefing, which is included in the materials, if you're interested, also gets into the substantive issues.
Hey, Sebastian, question for you before we move on to Sub F. Any risk that the Moors win? The Treasury going to have a little bit of problem with Sub F?
Yeah, I mean, I think so, right? I mean, Sub F has been there for a long time, and so everybody just assumes that it's constitutional. Because, of course, if it were unconstitutional, someone would have challenged it already. But just because something's been around for a long time doesn't mean it's right. So I think that's right. And guilty. A lot hinges on this more, litigation. So the department's position, in Nebraska, I'll just get into it briefly because it is a little bizarre. And I think a lot of people feel kind of passionately about it because what they're doing just doesn't make sense. The Nebraska statute explicitly allows the deduction for dividends deemed to be received from foreign subsidiaries. And so you would think that includes Subpart F. We usually think of Subpart F as being, and 965, as a deemed dividend. What the department is doing in Nebraska is looking at the federal foreign tax credit rules that tell you whether income is foreign or domestic source for the purposes of the foreign tax credit. And those regulations do say that for the purposes of the credit, the federal foreign tax credit, Subpart F is not a dividend. Nebraska picks up this regulation that applies in this narrow context and says that because Subpart F is not a dividend for federal foreign tax credit limitation purposes, it's not a dividend for Nebraska's dividends received deduction. It's sort of a bizarre position because the federal foreign tax credit limitation really has got nothing to do with the purpose behind or even the Nebraska Department of Revenue's historic view of Nebraska's dividend subtraction. And Nebraska's position also yields some bizarre results. For example, the department, in almost an attempt to reconcile their historic position that Subpart F did qualify for this dividend, they're now saying that some types of Subpart F are a deemed dividend, and some types are not. So, for example, if you have a CFC to CFC or foreign to foreign dividend that is characterized as subpart F, well, they're saying that's a deemed dividend under federal law, and that type of subpart F is eligible for Nebraska's dividend deduction. They're basically just almost looks like they're looking in the subpart F rules. And if they see the word dividend, then they say, okay, we can deduct that type of subpart F. It's a little bit of a bizarre and frankly almost irreconcilable position. So while cost is fighting this out at the courts, there's taxpayers that have this at the administrative level who are waiting to see what happens. The position in Rhode Island is very similar. No one has challenged it in court yet, but it should be challenged. It could be challenged. One difference I would say with Rhode Island is that the department did go through the regulatory process, so it is a regulation as opposed to Nebraska, who took its taxing 965 position through in informal letter rulings and notices. But in Rhode Island, the fight might be a little bit tougher because it's a regulation, but frankly, it still appears directly contrary to statute. So let's add these positions to our chart. So in these two states, our view is that you can take a 100% deduction for 965 income without regard to what the revenue agency says. So before going on, just interested to do another polling question. Does costs Nebraska 965 litigation impact you? We'll leave that up on the screen for another minute or so. If you could just answer it, that'd be great. I'll turn it back to Kyle for the next issue. Kyle, I think you're on mute.
There you go. Thank you, Sebastian. Sorry. There's another issue that is near and dear to our hearts, and that is this rolling conformity issue. Taxpayers didn't focus on this so much, with little changes with the Internal Revenue Code that would happen over the years. But really, with tax reform, it's come front and center. And that's a question whether under the state constitution, whether a state legislature can essentially delegate to Congress legislative lawmaking powers. In other words, can a state simply say to Congress, we hereby will let you define federal taxable income, whatever that is, and any changes that happen at the federal level just automatically happen at the state level. And there's many judicial decisions out there that say when state legislatures do something like that, they are unconstitutionally, and that is in violation of their own state constitutions, delegating their legislative power. And there's many cases out there that say the state legislatures can't do that. And we think that's particularly so in these two states on this issue, in Oregon and Rhode Island. In fact, I'll say as a side note, some states like New York and Illinois, they actually amended their state constitutions to explicitly allow for rolling conformity, because they recognize that without a specific state constitutional provision, that rolling conformity, automatic conformity to what Congress says, will violate their state law. So in these two states, you have the additional issue of there's a problem with rolling conformity, and that 965 shouldn't be adopted into state law at all. So here we have, continuing to fill out our chart, non-delegation in these two states as a potential solution.
Kyle, if I don't like 163J in those states, or perhaps some other states that have this constitutional provision, can I just get rid of everything I don't like about tax reform?
Yeah, well, whether you don't like, and maybe some things that you do like, but that's right. And I would say, just as an aside, Pennsylvania has an extraordinarily strong non-delegation set of non-delegation case law, making 163J completely dubious in Pennsylvania, if that's catching you there. I don't want to get too much on a side tangent with that, but yes, Sebastian, that's right. There are other states involving other items under tax reform where this non-delegation doctrine is relevant as well.
All right, well, I'll pick up there and talk about another cool and unique issue. I don't know if I'll get away with calling it cool, but I'll do that and see if I can. This issue applies to states that allow the 965C deduction, that is, states that tax the net 965 amount. Said another way, they tax 965A reduced by 965C. In short, the issue in these states is that calendar year taxpayers get a bigger 965C deduction than fiscal year taxpayers. That means that if you're a fiscal year filer, you're going to pay more tax on 965 in these states than if you were a calendar year filer. And that's just because of the way 965 functions. There's a built-in mechanism that works fine at the federal level, but when it's adopted into state law, it creates bizarre and potentially discriminatory and unconstitutional results. So let's walk through an example. So we used the numbers from Kyle's example a few slides ago. We're just going to focus on the 965 amounts in the state tax base. So 965 imposes a tax on foreign earnings at 8 or 15.5%. But let's just assume for simplicity that for the rest of this example, that the income is subject to tax at the 15.5% rate. Okay, so why is the taxpayer's 965C deduction $56? Well, it's so that the 965A amount, that $100, which is the taxpayer's undistributed earnings from 1987 to 2017, is taxed at an effective rate of 15.5%. So here, the net inclusion is $44. We're still on the left-hand side of the slide here, 2017. When you apply when you take that $44, we're on the bottom left here, and apply the 35% tax rate, which was the US corporate tax rate in 2017, you get $15.5. So the deduction works at the federal level. A taxpayer with $100 of foreign earnings will get the 965C deduction and pay an effective tax of $15.5 out of 100, which is 15.5% on its foreign earnings. For fiscal year taxpayers, then it works out a little bit differently. The 965 inclusion is in a year in which the U.S. tax rate was 21%. And so what that means is the 965C deduction changes. So moving over to the right-hand side of the slide here, if a taxpayer's inclusion is $100 in 2018, its deduction is going to be 26, not the 56 that the calendar year taxpayer got. And that's because when we apply the net amount, the 965A minus 965C, and the net amount is 74. When we apply that $74 to the effective U.S. tax rate in 2018, we get $15.5. The same tax on the $100 of foreign earnings that the calendar year taxpayer had. So at the end of the day, again, it works fine at the federal level when there's a change in the effective tax rate. But
so the key, Sebastian, though, this is fiscal year taxpayers. This is a significant difference. Right? It's doubling that deduction. Right. And what we're saying to fiscal taxpayers is you may be able to double, if I'm hearing you right, double the amount of that 965 C deduction so that you're treated the same as your calendar year counterparts, because at the state level, there's no rational basis for the difference in that deduction.
Yeah, that's exactly right. Yeah, it's a bizarre quirk, and it's incredibly unfair, and arguably violates state constitutional uniformity provisions like Louisiana's or equal protection clauses. There's no reason to treat fiscal year taxpayers and calendar year taxpayers differently, to tax 965 differently solely because of how they, the basis that they file their return. So again, let's add it to the chart. So again, in these states highlighted in red, fiscal year taxpayers have a position to take a bigger 965C deduction than they took at the federal level on their state returns. All right, so moving on. So the next issue. So there's some states, and we talked about Nebraska and Rhode Island a few moments ago, who through administrative fiat have disallowed the state deduction on 965 income. Well, these two states, Montana and North Dakota, haven't gone quite that far, but they are disallowing the 965C deduction through an administrative rule or guidance. They're basically taking the position that 965C deduction is not allowed. And in both of these states, that's arguably contrary to statute. Let's take North Dakota, for example. North Dakota is pretty upfront about their position. They explain it in their tax reform notice, and they even explain the basis for their position. They're saying that the 965C deduction it's like a dividend, and because North Dakota adds back dividends to taxable income, they're going to treat it like any other dividend and require it to be added back. But that's not quite, it doesn't quite align with the statute in North Dakota. So, North Dakota statute has a statutory deduction for dividends and a statutory deduction for subpart F income. There's a statutory add back for dividends, but there's no statutory add back for subpart F income. So in short, when North Dakota says that they want to add or subtract subpart F income, the statute says that they're going to do it. And there's no statutory provision that adds back the 965C deduction. So in our view, the proper way to interpret the statute is that it allows the 965C deduction. Montana's a little bit more sneaky. They don't, in their tax reform guidance, they didn't come out and say they're disallowing the 965C deduction. But if you work through their tax forms and their instructions and how they tell you to transpose the 965 amount from the federal return, the ultimate result is that they disallow the deduction. And again, if you work through the statute, there's no basis to do that. So, in Montana, just like North Dakota, our view is that you can take the position that you get the 965C deduction, even though the state revenue agency has said administratively that you do not. So we'll add that to our chart here. All right, Kyle, I'll toss it back over to you for the next issue.
Great. So that leaves us with a couple of states that tax the actual cash distribution. They've always taxed it. So in a sense, nothing's new, nothing's different. California and New Hampshire. But what's of course different is that we have a lot of companies who, now that they've paid the transition tax, are more freely repatriating cash back into the United States. And so that we're seeing a lot more cash come in, and we're seeing these states, California and New Hampshire, California in particular, we're seeing a lot more dividends come into the combined group in these states. And for example, California only allows a dividend received deduction of 75%, leaving 25%. But of course, that's a big number if you're talking about several $billion of cash that you're bringing back into the U.S. So you end up in a state like California with a big slug of income in your base, not covered by the dividend received deduction. So the question for us is, what do you do? Well, really, the answer is you do the same thing that we were talking about before for the 965 inclusion, and that is that you include in the factor the sales. It's important here, not the dividend, but the sales of the CFCs that gave rise to the dividend. The sales that produced the earnings that resulted in the dividend that's included in the base, and not just last year's sales, not just your 2017 sales, but again, the aggregate of all the sales for all the years that gave rise to the EMP that ends up getting distributed by way of the dividend. That's the sales that needs to go in the factor. Now in California, if you're allowed a 75% DRD, you may reduce your sales included in the factor by that 75%, but still it could be including a significant number for some clients, several $1 billion worth of sales that go into the factor in California on account of the cash distribution that you brought back. So continuing to fill out our chart, we have now CFC sales that are added to those states. So that leads us up to a polling question. The polling question is, have you tried to get factor representation on cash dividends in California? Have you tried to get factor representation on cash dividends in California? Yes, yes, and I have been successful. Yes, I've tried, but I have been unsuccessful. C, no, it's too difficult to get subsidiary sales data. D, no, not worth trying. And E, I don't know. Prefer not to say because I don't know. No, I prefer not to say. So we'll leave this up here for a little bit. One comment I will make, that the law on this is particularly good in California. A while back, when the Board of Equalization was deciding California tax cases, they decided in favor of the taxpayer Argonaut in a factor representation case involving dividends, involving whether dividends must be accompanied by a factor representation. Taxpayer won that at the Board of Equalization. It wasn't even a court case. Now that was a company that involved insurance subsidiary. California only allows a 80% DRD for an insurance subsidiary, but the taxpayer's argument was the same. Look, if you're going to include the income in the base, you need to include the factors as well. So we'll let you finish up that polling question, and then we will move on. I think, Sebastian, the next thing we're going to talk about are those states with that NOL problem you alluded to earlier.
That's right, and this is it's a great problem in the sense that it's interesting, but it's a really bad problem in the sense that it sneaks up on a lot of taxpayers. So, for most of these states, Delaware, Florida, Missouri, and New York, it's a 2017 NOL problem. That is, because of 965, your NOL generated in 2017 might be less because of 965. And so if you look at returns, your tax returns in those states, if you have zero state taxable income or a loss, then you might have this issue. New Jersey's problem is unique as compared to the other four. It doesn't just impact, 965 doesn't just impact your NOL generated in 2017, but instead it can eliminate entirely or significantly reduce your pre-2017 NOLs. And that's because there is a DRD ordering rule. Basically, you have to apply your NOL deduction before you get to apply New Jersey's 95% DRD. And that's an incredibly bad result, especially in the year that you get, that you're required to include 965 income, because it's just so big for so many taxpayers. It's more than the dividends you would pay year to year. So for these states, we think there's a basis to restore your NOL, and that is basically calculate your NOL as if 965 didn't exist at all. And we have a series of webinars that walk through the problems in most of these states. And if you'd like links to those, put in a question there in the webinar platform, and we'll send you the links. I'll turn it back to Kyle.
Great. Thanks, Sebastian. So that leads us to, I think, is our last polling question, Sebastian. I think this is our last polling question.
Last one. Yeah.
All right. So what state's 965 issue most concerns you? What state 965 issue most concerns you? So issue A, the state tax on the 965 inclusion, that is sort of the direct inclusion of that 965 income in your base. Letter B, state tax on the actual repatriation, California and New Hampshire. C, losing tax attributes, Delaware, Florida, Missouri, New Jersey, New York. We ought to look at New Jersey, New York, and Florida in particular. Boy, those can be big. We have clients that have significant, billion-dollar plus losses of NOLs. So definitely worth going back and taking a look whether you lost NOLs on account of 965. Is that an issue? Letter D, pending legislation to tax 965, like what's going on in California there. It's my plug for CalTax. If you don't want that to happen, call CalTax and lend your support. And Cap E, letter E, none. I don't have any state tax problems. I just joined this webinar to hear about more. So we'll leave those up. The inclusion, the repatriation, losing your attributes, pending legislation, or none. Okay, and that brings us to our last slide. What's next? Well, the next step is for you to consider protective refunds. We led off the program with protective refunds potentially to be claimed at the federal level. You have to be careful there. Just make sure that that you've thought through what will happen if that income is no longer previously taxed. If you get the refund, but by the same token, if you paid a lot of federal tax on 965 income and the Moors win, there could be a pretty significant refund coming your way. Separate from that, though, are all the state issues. I think we went through 21 states, lots of issues, lots of opportunities for refunds, but this is the year in a lot of states. You know, small states, even if you think it's not a whole lot of tax, there's a lot of taxpayers with each of these problems. We have put together a rider, which for each of the states, for each of the issues. If you're interested in filing a protective claim, let us know. We'd be happy to share that with you. The statute is running. Many of these states, the claims will expire the fall of this year, some as early as September, some as late as November or December, but it's definitely something to look at to make sure that you don't miss the statute on these opportunities. So that brings us to the conclusion of our program. We thank you for participating. Enjoy the rest of your day.